These are the 5 secrets that people that are able to retire early know that folks that are not able to retire early don't know. And I've been a financial advisor for over 20 years. I've helped hundreds of people retire. And these are the 5 secrets that I tried to share with my clients so they could be amongst the group that retired sooner rather than later. Imagine what your life would look like if you could get 2, 3, or even 5 more years, your healthiest, most active years in early retirement. So let's jump in. The first the first secret is understanding that asset allocation is really the key to investment success. A lot of folks think when they're looking for a financial advisor, when they're building their own portfolio, a lot of people think that they need to pick the right stocks. And multiple studies have been done that show, that's not the case. In fact, the famous study is a study called Brinson, and they interviewed people, and people thought that stock selection accounted for 65% of portfolio success. But when Brinson and his team did the analysis, the stock selection accounted for just a tad over 4% of the portfolio success. So what's the big factor that makes a difference? It's your asset allocation. What percent of your portfolio is in stocks and what percent's in bonds? That's a really key element. And to get that right, I strongly encourage you to work with a fee-only, a financial fiduciary advisor that has your best interest in mind. Okay, and to demonstrate this, I want to share with you Vanguard's study. This is from a research report they put out that it's called Principles for Investing Success. And you can see here, this is based on different asset allocation. And it shows you the high end of the returns and the low end of the returns, kind of the best case and the worst case, and then the average annual return. So this is an important chart to think about, but in reality, it is your asset allocation has as much to do with yourself and whether you're going to be able to sleep at night. So let's jump in to the next one, and it kind of ties into that sleep at night factor. If you look at that chart view, the chart from Vanguard, you'd say, hey, Azul, why wouldn't I be in 100% stocks? That has the highest return. Well, the reason you won't is because when the stock market goes down, it has the highest return, but it also has the biggest negative. And so taking a 20% loss on your stocks, on your portfolio, imagine if you've got $500,000 saved up and it's all in stocks and you took a 20% hit, that's $100,000 that you just lost. And it's just human nature to think, how long did it take me to save $100,000? And that's what this chart here shows by Dalbar. And it's the behavioral effects on investor returns. And they evaluate 401ks, and the investment choices that individual investors have, and how did the individual investor do? So you can see over this time period, the best returning asset class was gold. The next one was REITs, which is essentially real estate. Then the S&P 500. You can see inflation was 2.1%, and the average investor did just a little bit better than inflation. And this is one of the reasons that people are not successful in achieving their investment goals. So rule number 1 for investing is, I don't care how much you earn, you have to spend less than what you earn. But it's not enough to save, you also have to invest, and you have to invest successfully. Now, fortunately, it's not that hard to invest successfully. We saw that. It's picking the asset allocation. You don't have to be Warren Buffett that can pick individual companies, but you do have to keep your behavior in check so you don't end up like this Dalbar study shows, over a 20-year return. Investors getting just a little bit more than inflation, where the S&P 500 did 7.5%, gold did 10%, things like that. Okay, related to that is it's time in the market that determines your success, not timing the market. So we want to pick an asset allocation that we can stick to over long periods of time, because it's sticking to that asset allocation that is key. And it's not blowing out of your investment portfolio, selling stocks when they're down, blowing out at the exactly wrong time. And a recent example of that was during COVID. That was the fastest correction. That was the fastest, almost a 30% drop in 20 trading days. That was the fastest 30% drop in the S&P 500 in its history. And you can see here when COVID started and it took that plummet that I said about 30%, for folks that blew out at the bottom and then stayed in until the S&P 500 got back to where it was before COVID, instead of getting a 21% return, they would have essentially stayed flat, which is not awful. I've seen it worse, where instead of getting a 21% return, maybe they got a negative 10% return or something like that. So it's important that we can stay the course and not try to time the market, not try to say, oh, the market's down now, it's going to get worse. That's the siren song for investors. It's going to get worse. I'm going to get out now. I'm going to avoid having future losses. And then when it starts coming back up, I'll get back in. The challenge is the stock market tends to go down and then some of the best performing days tend to be right after the worst performing days. So it's very easy to miss out on that. And once you get out, if you didn't like the price when it was down 20%, you're sure not going to like the price when not only is it back to even, but it's up another 20%, because then it's going to seem real pricey. So I've seen this have significant negative impacts on people's retirement accounts. I don't want to see that happen to you. That's probably the number one thing that I saw that destroyed people's retirement prospects is blowing out of the market, selling their stocks at lows. Okay. Number 4 is related to this, and that is try to avoid being a forced seller in a down market. Now, there's 2 ways people become forced sellers in a down market. One is you're retired and you need to take money out of your portfolio for your living expenses. Or there's really 3 ways. Another way is people have debt and they have to pay back the debt. That bank says, hey, your loan is due. I see that with real estate developers. That's probably not you. But the third one is something that unfortunately we're all subject to, which is just the mental anguish, what I call angst, when the market goes down 20, 30, 40%. Don't think it can do that 20, 30, 40%. In the great financial crisis, top to bottom, the stock market was down almost 60%, 60%. And boy, that was, if you stayed the course during that period, kudos to you, because that was a hard time to stay the course. Now, just because you did that when you were 40 years old or 30 years old or even 50 years old does not mean that you'll be able to do that when you're retired in 65, because the pain of downside movements in the stock market, the pain of losing 20% of your portfolio increases exponentially as we get older. So how do we protect ourselves from that? We go back to point number 1, which is asset allocation. We go back to that Vanguard chart where I said, people will ask me, hey, Azul, why don't I just sign up for 100% stocks? We don't do that because you're likely going to blow out of the stocks when the market goes down, even if you've been able to weather the storm in the past. Just full disclosure, none of this is financial advice. I don't know your situation, but I do know human behavior, and I know it's just normal to think, how long did it take me to save my first $100,000? And now my portfolio is down $100,000, and man, that feels really painful. Okay. Related to all this is time is an investor's best friend. And we can see here by this chart, this is how long it takes to grow to $1 million. If you can save $10,000 a year in a diversified portfolio, and let's say you got 7% a year each year for that, how long did it take you to save your first $500,000? It took almost 21 years. But look what happens in the last 8 years. you gain that same $500,000 in 8 years instead of 21 years. So it's getting that initial base. So time is your best friend. So hopefully this video has been helpful. If it has been, YouTube says that you'll like this video as well. Take a look. Let me know if they're right. Thanks for watching. Bye-bye.